And he looks so good. He brings all of his family. But just a quick kind of like rundown of what we do here. This is a SubTo Meet Up. SubTo is a nationwide investor group started by Pace Morby out of Arizona, but I think it's the biggest investor community in the country, maybe in the world. I don't know. I would guess in the world at this point. There's probably 30,000 members. And they just had, I think Kristen is here. Kristen, you went to Squad Up?
Yes.
Squad Up Summit?
Yep.
They just had Squad Up Summit, which happened last week, and I think it's the biggest real estate event. I don't know if it's in the country now or in the world, but it was like 2,700 people, I think, that went to it.
Oh, it was a lot there.
Did you go, Julie? Yeah. How was it?
Oh, it was good.
Who else was there?
I was there.
Zach was there? Any big takeaways, or did you guys like it? Was it worth it? Not worth it?
Yeah, it's fantastic.
Yeah.
Got a lot of great takeaways and a lot of great information, a lot of great connections.
Yeah.
A lot of good speakers.
Yeah. Was there a top speaker that you
Barbara.
recommend people going to look at their content?
I like Barbara.
I liked Barbara too. She was awesome.
She was awesome.
Barbara Cochran.
From Shark Tank.
Oh, okay. Yeah.
The Barbara?
The Barbara. I don't watch Shark Tank. Yeah. But she's
Vic
good.
Keller had a lot of good stuff to say
Yeah,
too.
Who did?
Vic Keller.
Okay.
Yeah.
He's the car wash guy, right?
Yeah.
Cool. What about with the SubTo people specifically? Was there a SubTo? Because they try to prop up like some of the big people. Was there?
Yeah. What was her name that bought the trailer? The RV car?
What was her name? The girl that bought the trailer. I
I
can't.
want to say it's like Reba.
Oh,
Not
Rhea.
quite Rhea.
Rhea
Rhea.
Cameron?
Oh, yeah, Rhea.
Yeah.
She had a good one. She was good.
She just bought like some huge golf course,
Yeah,
RV
golf-
park with
RV,
Pace type
yeah.
of thing.
They
Casey
closed down.
Anderson spoke the last session of it.
Oh,
Oh, yeah,
sweet.
Casey did.
Yeah, Casey. And Casey's spoken the Omaha RIA twice now, I think. That's cool.
Yeah,
Great.
it was good.
Yeah, hopefully I can make it next year. But
San
San Diego.
so
We
San
got our
Diego.
tickets.
All right, that sounds nice.
You guys
Yeah.
went on the cheap ones?
Yeah, we
So
did.
How much were they when?
$297.
Oh,
My
$250.
man.
That's pretty good.
How you doing? I like the pants.
Yes, yes, matching.
Yeah, I like the shirt though. It's good to
Yes,
see you,
yes,
dude.
yes. You got this, you got this.
I hope so. It's been so long on the
Sweet,
presentation.
yeah, so
So
that was a
Let's see.
SubTo event that they
Yeah.
did
Thanks,
for
brother.
this
Thanks.
year. And so it's just growing a bunch. It's a big investor community. You don't have to be a part of it to be here. It's not a sales pitch or anything. If you want to learn more about like creative finance, that's kind of what it started with, is SubTo, subject to, that's taking over a property or a house, subject to the debt that's already in place. So you're taking over somebody's mortgage, you get a good interest rate, you don't have to pay as much for it, you don't have to have all the credentials to get that loan to buy that property. So it's a great way to get into real estate with not a lot of money, especially if you're just brand new to it. So, but SubTo goes into everything. A lot of people are really into RV parks and mobile home parks. That's a big thing that they're doing. They're doing a lot of challenges, things like that to hold you accountable, teach you, train you, take you to the next step. So if you're interested in that too, you can always talk to me about it. There's SubTo. I know Jacob back there is in Gator. Alex, you in Gator too?
Yeah.
A couple people are in Gator. It's Grant is in Gator too. So if you want to,
I'm in Gator.
what's your name?
Darren Zolke.
Oh, hey Darren.
it's just Darren.
I didn't know you were in Gator.
Yep.
Oh, cool. Sweet.
And make sure you say you're in it, but you don't say was. Like, you did it, like did the program. If you say was, Pace will get mad at you.
Oh.
So,
Yeah,
I'm
okay.
telling.
Yeah, so Darren's at Gator. And so the Gator, so SubTo is like the first one. It's the most broad. It goes over all the different like investor strategies, whether you're doing wholesaling, you want to do, just investing in rentals, long-term, short-term, any of the RV parks, mobile home parks. Dave's doing the co-living situation. So all those different strategies you can kind of learn in there. There's networking, any type of resource you need anywhere in the country, basically you can find within SubTo. And then Gator is kind of like a smaller segment to SubTo. It's separate. You can sign up for it too. It's all about private money lending. Whether you have money to lend or you don't have money to lend, there's different strategies that you can do to make money in real estate. You don't have to, go swing a hammer to be in real estate. You can just deal with money. You don't have to buy rental properties, you can just deal with money. So there's a lot of different things there, but happy to talk with anyone about that, and same with anybody here. So just a couple of things here. We normally do meetups on Tuesdays, but for the next couple of months we're doing it on Wednesday nights, so just like tonight. And then if anybody wants to speak in future meetups, you don't have to be a world professional real estate investor to talk here. Like if you've done a deal and you want to talk about your deal you've done, let me know. I'd love for you to share it and what you're looking to do in the future. And it doesn't have to be an hour. It could be 30 minutes that you want to do. So happy to give people the stage and practice speaking, practice talking about real estate, whatever you want to do up here. Would love for you guys to do that. And then next month we're gonna have Darren, who I didn't know what he looked like in person. He's gonna be talking next month. I think it's April 15th, tax day. Woohoo! Yeah, great day. You should not be busy that day. You should do it before. And then what are you going to talk about, Darren?
So yeah, I'm going to talk about health, and so I think that's a big part of it. If you don't take care of yourself first, then you can't take care of others. And yeah, I've been a full-time investor for 7 years now, so I'm going to just share my journey and what I've learned, and hopefully what I've learned, if I can help one person, then that's my goal. So,
Sweet. Thanks, Darren.
yeah.
And then in May, we're going to have Jeff McGregor. He's got a bunch of storage facilities, and he has like a fund, which I don't totally understand, but he can kind of tell us more about it in storage facilities. So he's going to be talking about that. He owns, I don't know, it's like 20 plus storage facilities in the Midwest. So that'll be really cool, just totally different. A lot of us are doing single family homes or multifamily. That's just a totally different realm, so that'll be really interesting as well. But here today we got Neil. Neil, I moved back to Nebraska like a year ago, and I had like all my good setup, all my people in California where I was working, and one of the things to have for a realtor is a great lender. And I was like, I gotta like find new partners and stuff for that, and people that know what they're talking about. And conveniently here, this is at Realty One Group Sterling. This is our office here for our brokerage. So I also want to give them a shout out. They let us do these meetups here for free every month. So it's super awesome. Tim and Jeremy are part of the brokerage as well, and a few other people. So thank you guys for letting us do it here. And they're really investor friendly brokerage. If it's legal and you can do it, you can pretty much work with somebody here at Really One to do it, and so that's really nice. Like, we're not just a retail brokerage where you buy and sell pretty houses. So we can do their dirty houses too. But they also partner with Neil and Aspire Mortgage here. And when I was looking for a lender to work with on my clients, I wanted somebody that just didn't know like numbers and talking about mortgages, and like they actually do real estate. So that's kind of what Neil is going to talk about. And he does multifamily, he does fix and flips. He's done a lot of different things, and he does the lending side. So it's a great person to know. I definitely recommend, like any of my retail clients that I work with, I try to have them work with Neil because they go the extra mile and just are great for that. So I'll let him give you a little bit more about what he's doing and go from there.
Okay. First, can we give it up for Josh? He works so hard to put on these events. You guys, who here hasn't met Josh personally? Just now? You should make the effort to. He's incredible. Everywhere I go on social media, everything I'm doing, I'm seeing Josh right now. I don't know if he sleeps. He never stops. And huge shout out for letting me go before Darren, because I would not. He's a humble guy. I wouldn't want to be the guy that goes after Darren. So, guys, I'm here to talk to you. He kind of gave me an open-ended topic. For me, it's open-ended as finance. I've been investing for a decade, and I think there is depths to the directions you can go with finance. And people all the time are like, Neil, what's the best loan? What's the best this? And it isn't ever that simple because it's so tailored to you guys individually. So I didn't come here to pitch one thing. I just wanted to go through the tools that I use as a flipper and the tools that other investors that I help work with use the most, so you guys could help kind of learn what's best for you. Now, in this room, who here has an investment property? So about half, okay? Who here has flipped a house and sold it? About half. Perfect. So we're going to talk about that, and then we're also going to talk about the takeout or the long-term debt on the back side of it. Leverage, I like to bring it up front. It's like a disclaimer. It's like fire. It separates the man from the monkey, but if you aren't careful, it'll burn down your house. So I think it's my own quote, but I watched a speaker quote himself one time in a room full of people, and I was like, that is the douchiest thing I'll ever do. So I literally typed Neil Galas. It was like, I can't do it. Get rid of it. Can't do it. So it's just a bad way to start. So I wanted to talk a little bit first and just kind of say who I am, what I've done. I've been an investor for a decade. So I started as a realtor. I did that for the first half of my career. Realized I was more of a numbers guy, transitioned over to the lending side, which is really where I found my passion. But from the very beginning, real estate investment has always been my dream. So I was 19 years old and I wanted to be a landlord. That was the direction I was going to go with my life. I just really didn't know how I was going to get there. So I have been running Beard Bros Building Co. with my partner Dalton for the past 6 years. We bought 22 houses last year. Really pissed about that because we had 2 deals in December that didn't close, and the goal was 24, which was going to be a house every 2 houses a month, which that was our attempt. So we fell short of that, but we do a pretty good clip. And so being an investor and a lender and having, we have rental properties, single family, multifamily, long-term, short-term, furnished rentals. I've gotten to experience a lot of sides, and I started probably not where a lot of people would expect. There's baby Neil, a beautiful, beautiful head of hair. And I thank my parents for that. I thank my Papa Bill. Hopefully I get to keep it. But where my journey started, I was 19 years old, and I decided I was going to be a real estate investor. So I've never been to college. I've never stepped foot in a college classroom, and instead I went to Job Corps, which was all trade focused, because in my mind I was like, I'm going to get out of here and I'll be able to work on my own properties. Because at that time, that was like the highest level of leverage on my time that my brain could think about. Like, man, I could save money by doing the work myself. And the funny thing is, people are like, Neil, you must be great at construction. You have flipped a lot of houses. And it's like, no, I'm not handy. I'm just bossy. And so I learned really quickly that the hammer was not for me, but Job Corps is where I started. And then from there, I became a carpet cleaner and did that for 2 or 3 years while I got my real estate license. And this part of my journey is important to me because it's more important than where I am now. And I think people get up here and they speak and they go, oh, I've made all this money, I've done all this, I've had all this success. But what a lot of people don't speak about is their failures and how long it took. It took me 4 years from the time I was like, I'm going to be a real estate investor before I bought my first property. It was a 4-year journey. It was a 2.5-year journey before I said, I'm going to be a realtor, before I actually got to be one. And it shouldn't take that long, but I was young, I was working a lot, and it took the time that it took. And so I think it's really important to slow down and say, hey, like, you can do this. It's not easy. If it were, we would all do it. But if you're in this room, it's because you want more. And so it is a hard journey. You will have knocks. It's just about, can you continue? And that's really what separates real estate investors. So just a little bit about my background there. So I wanted to kind of get into my first 2 deals to break the ice a little bit. I bought them both at the same time. I built a pitch deck. Didn't have any money. I was 23 years old, and I built like a 5-slide PowerPoint. And at the end, it was like, invest in me, right? And I took that to everyone I knew. I took it to my friends' parents. I took it to my parents' friends. I went to rooms like this, 23 years old, couldn't grow a beard, and tried to shake a pan and have people put money in it, right? Just like whatever I could do to get people to invest. And it worked. I raised $130,000, and I was 23 years old. And so I had the money ready to go to buy houses cash. Now I had no construction experience or real estate experience really, but I had the money. So now we were in business. The first two deals I bought at the same time. The first one I bought for $20,000. I mean, what can go wrong? You buy a house for 20 grand. How can you lose, right? I skipped title insurance, which you shouldn't. And your realtor will tell you not to, but I was like, but $300. I don't want to, come on, right? It's not in the budget, right?
Were you a realtor?
I sure was. But, it's easier for me to tell my child to eat his fruits and vegetables than it is to eat your own fruits and vegetables, So I think there was like some of that dynamic going on, right? And so it turns out the house was on the demolition notice. So I bought the house, I called the city, and they said, oh, you bought it? That's great, we're knocking it down. And I was like, no, I just bought it with that guy's money. This is the problem. You can't knock. And they go, well, we're going to knock it down anyways. Like, it's too far gone. And so after 4 or 5 months and a lot of protest, we removed the house from the demolition notice. But if a house is on the demolition notice, if you guys are taking notes, you can assume it's been inspected and it is red tagged. So what I thought was going to be $20,000, $30,000 of renovation was actually like $65,000, $70,000. I had a conflict with my partner at this time, who was family. And at that point, they hopped out of the deal. So I was 23 years old, new baby, stay-at-home wife, no money. And what I thought was $30,000 was now 60, 70. And I was so thankful that they didn't knock down the house. I had something to look forward to. So I closed on that deal on February 15th. And 2 weeks later, I simultaneously bought a second house. So I didn't just start by doing one. That's never really been my speed. So I bought two at the same time, except this one I partnered with a general contractor. Once again, trying to leverage against my weaknesses. I didn't have the money, found the money, didn't have any construction experience, thought I found the construction experience. We bought that house for $9,000. Once again, what can go wrong? Hey, how could you lose? Come on, right? So fast forward 18 months, and I was able to sell and close both those deals. 3 months into renovation on property 2, I found out the general contractor was just stealing the money. Wow. Which is extra bad because it's not even my money he's stealing. He's stealing someone else's money who trusted me with the money, who now I'm responsible for paying it back for work that wasn't done in a property. That's also red tagged by the city, right? And so that second property I bought from the land bank. And the land bank, they have a 9-month agreement that if you don't finish the house in 9 months, they'll repossess it from you like a car. Regardless of condition or money or anything, the land bank maintains the right to, but I partner with the contractor. You're laughing, I partner with the contractor. Like, no way it's gonna be 9 months, right? It took us 15. So it just every couple months, every month I had to call and beg them not to take the house from me, that we were progressing, that we were getting through it. And how I finished these first 2 deals, because essentially I borrowed this money and threw it in a blender. It's gone, right? It's budgets that aren't met, interest is ticking, it's stolen by a contractor that I paid not to sue me, even though he stole from me, but I was young and scared and he had money and age, right? Yeah. And so it was just a lose, lose, lose. So what I did was double down. And I went back to where I started, and I came back to this meetup event. I found a new person who saw what I had going on and was like, this kid's got it. And we went and we flipped 3 other houses successfully, took the profits from those 3 houses, and then turned around and dug myself out of those 2 projects. But in the meantime, they sat on hold for 6 months at a time at 18% interest as I sorted out how I was going to come up with this construction money. So the first deal, I was $110,000 in, and I sold it for 94 grand. So I was 23, 24 years old, and I had just lost $16,000 that I really didn't have. What I learned is what you don't know can hurt you. Title insurance, good. Are they planning to knock down the house? I've never thought to ask. If you haven't thought to ask, I'd ask. Just telling you. Just ask. Yeah. And the second house, I was $115,000. Now, if you remember, I bought it for $9,000. But the price was right. Ended up being $115,000 into it. I sold it for $86,000. I lost another $26,000. So I'm literally working to just pay off my mistakes. And this is one of my favorite quotes. The more you know me, the more you'll hear it. What I learned is you don't know your numbers, you don't know shit. And this is real, and this goes to every one of my investors. Every time I'm in a room, and they're, oh, I flipped the house. I go, great. I go, what'd you make? And they go, like 30. No, you didn't. Oh, you have no idea. You did this for fun for all you know. You have no idea, right? Because there are so many hidden costs, and we're going to get into those a little bit tonight, that people don't consider, whether it's holding costs or real estate commissions. How many people are flipping houses that are asking me how those work? Those are big dollar amounts. They're important. Realtors are important, but you should know how those are going to affect your margins before you start buying real estate, and especially when it comes to your contractors. So I'm going to go off a little bit here and how we operate now on our contractors. So we have 2 crews full-time. They do a little bit of like moonlighting, but they essentially just work for us. So we're trying to crank out 3 properties a month. That's our tempo right now, so we keep 2 crews rolling. I've tried time and material because I was young and dumb. I never agree to time and material. That is just how you will get milked as an investor. Are you guys familiar with time and material? So time and material, they don't give you a firm bid. They're just like, well, I'll charge you $25 an hour, $40 an hour, and you'll just pay me as I go. And I'll tell you how many hours I've worked there. That is the worst way as an investor to hire your labor. Sometimes it's unavoidable, and they will ask for it, but as an investor, it's a no-go for me. It took me a long time to figure that out. And then we realized that time and material wasn't going to work. We moved to payroll. So then we had a crew payroll. When I talk about not knowing your numbers, one thing we've done well is I have a master spreadsheet of every house Beard Bros has ever flipped with every single cost, every penny, every contractor, everything. And so we're able to, as we grow and scale over time, see. When my painter gets more expensive, I notice. When our carpet goes up, when anything changes in our numbers, we're able to see it because we're tracking our data so well at this point. So because we tracked our data so well, we put a crew on payroll, we instantly noticed that our material and labor was going way up because we just weren't managing them like you need to manage employees. So if you want to have efficient costs and you're serious about flipping houses, only accept bids, always get 2. And magically people start to get cheaper. The amount of times that we have our A team and we feel like the number gets a little bit high on us, because it does, because they do a lot. And so they will, eventually that number will creep up. We bring in the second bid. Would you look at that? A team will match the second bid. And so it's ugly. I know you're whittling people down, but as an investor, you have to fight for every dollar because money is a cruel mistress. And if you aren't paying attention to it, she will find someone who will. And so it's true. I mean it. So it really matters when it comes to these investors. So I put a pop quiz in here for everyone in this room. This is a really important lesson. Does anyone know the only type of ship that doesn't sail? Partnership. That's right. A partnership. So that would be the takeaway from my first 2 flips. And obviously I have partners now. And so I know it's tongue-in-cheek for me to say that, but the difference is the partnerships I have now, we don't need each other. And that's what I want in my partner. My house flipping partner, we have a clear line of the responsibilities. I do my half that I'm accountable for. He does the work he's accountable for. If he fired me, I could flip without him. If I fired him, he could do it without me. We don't need each other, but we do more together. Too often I see like realtor, contractor come together. It is the least profitable solution. And I'm an investment lender, so I spend a lot of my time helping house flippers build, scale, strategize, review numbers, review budgets. This is where we haven't really gotten there yet, but that's where I spend my time. And this is the flipping's kind of what happens in the background of what I'm doing in my day job. But it's always the worst combination that I see is realtor contractor. So if you're ever like, what to avoid is that combo.
What if they're married?
Worse. Actually worse. Yeah. But I see that one all the time. And here's why it doesn't work, because the billable rate of a good general contractor is so much higher than the billable rate you can afford to pay your labor if you're going to be a successful property investor. So you have to choose, are we going to have a construction company that loses money, or are we going to have an investment company that loses money? Right? And so if you put husband, wife, realtor, contractor, it loses. Or contractor, realtor, it does not work because they can't both have the margins that they desire in the investment space. So that's been my experience. But then this is a really fun story. And since I wanted to keep it light and give you guys a win after bringing you through my dirty laundry and showing you some painful losses, I call this one Big Blue. So this was the most interesting deal I've ever had a chance to be a part of. I was a lender. It was my first year. And I got a phone call. It was from the representative. This woman has a financial representative. So in this entire story, please remember, I never talked to the tenant. Never saw her, never met her, never had any interaction with the actual person. This woman calls me, who's in finance, and he goes, Neil, can you help this woman? She's going through a divorce. If she can't refinance her house, she's going to lose it because her husband's going to make her sell it so he can take his half, and the kid's in the home and she wants to keep it, and can you find a way to help her? I said, yeah, I'll take a look. I run her credit. It comes back at 480. You guys aren't lenders, but I saw you wince. You probably have put together you can't get a loan at a 480 credit score. And I was like, man, I want to help this woman. What can I do? And I looked at my partner at the time. He goes, Neil, you're an investor. Buy it. And I went, oh, yeah, I do that. I do buy houses. I said, okay, how can I structure this deal that it makes sense? So what I made her an offer, the reason I threw this in here is because this is the SubTo community. And you guys get a little bit more creative, so I wanted to share this one specifically as the win instead of just the flips. I said, hey, I will buy this house not for what it's worth, but what you owe. And when you're ready, I will sell you this house back to you for what I bought it for. And in the meantime, you'll pay me rent. I consider it triple net lease, which means like I'm not making repairs. I'm not in charge of expenses. Don't call me. Like, it's your house, but I'm helping you keep it. So I was going to make a couple $100 a month. When she was ready, she was going to buy it back from me. I still do these deals. I plan to buy a house tomorrow. He's really excited for me to come there. He's going through a divorce. I structure them differently. So now on top of taking the net rent, like the rent on top where I don't make repairs, I also add into the balance. So like tomorrow I'm going to buy it for $150. He owes $150. I'll sell it back to him for $165, $170 when he's ready. So now when I do it, I do build in like a capital margin on the backside and then the rental cash flow on the front side. Because in my mind, I'm taking money out of the machine that we flip houses with. So like, we're not a charity. If I'm going to bring the money out of here and devote it to this deal, I need it to return what a flip's going to make. But then it's a really easy, low risk, kind of slow flip type environment where we'll make consistent cash and then there will be, a sale event down the road. Or if he can't ever qualify or defaults, we take the house at that price, which is kind of like the win behind the win. Because, yes?
So what makes you decide that, you say you're going to buy it tomorrow or whatever, right? And you're going to let him stay there and pay his rent or whatever until he's ready to buy it.
Yep.
What gives you that inclination that he's going to pay you?
Well, I hope he doesn't.
Yeah.
Because then I'll evict him and I'll take the house for way better than it would have. Right. And so that's what I kind of love about the bet is you win or you win.
Right.
So like if he performs.
Then you gained a couple,
Yep.
10 grand or whatever out of the deal.
Yep, I made the cash flow.
Right.
I'll write it off on my taxes, do some tax sheltering, and I'll win on the exit.
Right.
But then if he doesn't pay his rent or can, hits the end of his balloon, it's a $300,000 house in Millard that I'm picking up for 150 grand. So I'm actually hoping he doesn't pay me, truthfully, right? So that, yes.
How did you come up with, if you buy for 150, you'll bake in the 15 grand? Do you have a certain formula for that?
I wanted, not really. I wanted to hit our flip margin, which is about 30 grand is what we want to make. And so I was like, if I can make an easy 30, why wouldn't I do the deal? Because I was like, it was kind of one of those things where I went, what do I have to make for me to want to do it? And if that makes sense, which sounds silly, but part of a huge piece of our equation as investors is velocity of money. It's how quickly you are turning it. And any time that I am sticking it anywhere for long, it needs to be getting an above average return because it's less capital that I can be flipping houses with, which if you flip successfully, not like the first two, flipping houses is like an 80 to 100% return on capital. It can be very, very outsized. So if you're pulling money out of that machine, you should have somewhere really intentional that you're putting it. And so that would be, no true formula, just like, whoa. It's kind of like when the contractor gives you what would you, like the tell me no price, when a contractor comes in so high because he doesn't want the job. It's almost derived to with that same type of motivation. Great questions, and thank you guys. Always, please, yes, continue to ask questions.
Existing rate's like 8%.
His existing rate?
What if it is? I mean,
Good question. I'm buying the house.
okay.
So I'll put my debt on it.
SubTo.
Yeah, exactly. So great question. So I'm not doing a SubTo in this scenario. Hilariously, my brain can't wrap itself around wraparounds. With all the tomfoolery and levers I pull in finance, something about wraparounds and SubTo just escapes me. So I stay a little more vanilla in this world. Yeah.
All your cash into it, or are you just getting a new loan for their debt amount?
I'll probably put $30,000 down and convince my bank to give it back to me and then have no money in the deal. That's my goal. That's probably what I'll do. But I'll have to put 25% down for a little bit. And I'm like, come on. And I'm sure we'll be able to kind of get it back up. How this one? Yeah, this is a fun one. So what's interesting about this one is, so she lived there for years. I never drove by the house. I didn't know what it looked like. I never went there. I never heard from her. The money just hit my account. What's really interesting about it is the day that I closed, I bought it for $225. This was pre-pandemic. Things were a little bit looser back then. My banker came to closing with a check for $75,000 to hand me. He says, Neil, every time we give you money, you double it. Here's $75,000, have fun. So I bought the house for $225, but I left with a loan for $300, because at the time the house appraised for $450, and I just bought it so low. My banker just showed up with a check, which is a really cool story. They don't do that often, but if you tell them to do it, they'll tell you no, but it can happen. And so I always knew that was going to be a problem for me, but I called it a future Neil problem, because I've agreed to sell this woman her house back for $225, because I bought it from her for $225, and now I have $300,000 debt on it, but her credit's $480, so I got years, right? So that's a future Neil concern. We need capital now. So we did the deal. And we roll 3 years later. She comes to me for a refinance. I pull her credit. She's 1 credit point too low. And I said, hey, come back in a couple months. You're right there. And in the background, I'm like, shit. I got to come up with the $66,000 I still owe on this that I have over leveraged on her property, right? And which we'd figure it out. Like we'd flip, we'd do whatever, we'd make it happen. But it was now a Neil problem and not a future Neil problem. Yeah, I don't feel bad for that guy. Future Neil, he's got it rough, yeah. But anyways, I get a call a month later from her representative, and they say, we get a text, Neil, we need to talk at 3:30 today. And I'm thinking to myself, I'm going, oh my God, like she went to a different lender, they pulled the credit, they found the extra debt, now I got to explain this, like I'll make it right, but now it's like a conversation I got to simmer. And they called me at 3:30 and they said, Neil, Nikki's dead. I go, what? And they go, but it's okay, we have a flipper, they'll buy the house from you. And I said, no, it's okay, I got it, I get it, no worries, I got it from here. And so it's in Happy Hollow. It was 1 block from UNO. She was hung in her closet. It was horrible. It was ruled interesting law. I know we're picking up a lot of notes here. If it's a suicide, it doesn't have to be disclosed. If it's a murder, it does. So she had a boyfriend that strangled women had criminal history for it, and then she broke up with him 3 days prior, and then she was found hung in her closet. And so they ruled it a suicide. And so because of the suicide, I didn't have to disclose it. That is something you guys should pencil down, because if you're going to be a serious investor, it's going to happen. You're going to run into this kind of stuff. It's just part of the game. So, hey, yeah. But no, and when I walked through this deal, what's interesting is it was such a windfall for me that I tried to adopt her. She had a 9-month-old baby. And I tried to adopt it because it was such an incredible windfall that I did not expect, because I never intended to profit really on this property. It gave me short-term cash, it gave me some benefits, but I did never expected what happened to happen. So just kind of walk you guys through it. When I bought it, it was $225. This is pre-pandemic. It was like 2016, 2017. True value was $450. At closing, they gave me a $75,000 advance that we used to go plow into the flipping business and continue to lend. I did it on a lease option, which means I own the property, which is a really important detail. It's my home that I'm leasing back to her, and she has the option to purchase it within a certain amount of time under certain agreements. And so I had it for, I think, 4 years, made about $300 a month, came out to 17 grand in net cash flow. When the tenant passed away, because it was a lease option, it was my property. I don't know how that works with other wraps and trusts and other types of creative financing solutions, but what worked out for me, it was not then given to her will or next of kin. It was, the agreement was Nikki could buy this property, and that was the agreement we signed. So it was deemed to be my home. It was rough. It was very, very rough, and it was like a 4,000 square foot house. I brought in a interior designer who specialized in 1920s era, and we really tried to match tiles and colors and patterns, that historic element. And it was a very, very expensive lift. So I put another $175,000 into it, but I sold it for $650,000. So on that one property, I netted over $200,000. I got the upfront cash that I was able to flip more properties with and accelerate the money. Every time I buy real estate, I accelerate the depreciation. It does create a lot of future Neil problems, but now Neil's addicted to it. So what accelerated depreciation means is when I buy a property, you typically have your straight line this is a different PowerPoint that I have, but it's called straight line depreciation. You'll depreciate, it's 3% a year for 27 years or 26 and a half or whatever it is. So as a real estate investor, if you're full-time, you qualify for something called REPS. Stands for Real Estate Professional Status. What that changes in the tax code is typically, for an investor, you have passive income and active income. You have passive losses and active losses. Passive losses can only offset passive income. Active losses can only offset active income. So you can lose $100,000 in rentals, and it can offset what your gains were in your retirement that maybe you pulled out, but it can't offset what you make in your W-2 or in your business unless you qualify for REPS. Then it does, which then becomes very powerful, because what you can do is accelerate the depreciation. So I take all 26 and a half years and I slam it year one. And so every time we buy a rental, we take a very large just tax write-off up front. And you can pay, I think I'll pay taxes this year for the first time in 5 years. But I've always been able to buy enough real estate to put my income below zero to where that I'm not paying taxes. And then you can file tax exemption if you're W-2. And then you're saving the 30-40% they would take. And as long as you're using that 30 and 40% to continue to buy real estate, you continue to get the deductions that you can keep the cycle going. So as long as you don't stop buying, you can keep it going. So definitely a detour, but it's an important piece of the picture. And then that entire time I owned the property, I was able to bolster my global net worth and lend against that. Because essentially I'll have I have a credit line against the portfolio. And so every year the debt goes down, the values go up, and the credit line gets bigger. And so even just having a property that I didn't think I was ever going to make money on, because I didn't know this was going to happen, I just knew those were going to happen, it made a lot of sense for me because it gave me cash up front, it increased my credit line size, I had the tax write-offs, I'd make a little bit of cash, and I could keep rolling. Does that make sense? And so I think a lot of times as an investor, people are like, what's the cash flow? I think the cash flow is almost probably the least important thing. Like I want it to be there so I'm not losing money, which I have properties that lose money every month. You don't want those. But when you start to think about appreciation, tax sheltering, depreciate, all the principal reduction, being able to leverage to buy more properties, the cash flow is probably the least important piece of the puzzle if your goal is scale. That being said, don't buy negative cash flow. Buy properties that cash flow. But I wanted to just kind of walk you guys through this win because it kind of illustrates that you can't have those big wins and you just sometimes don't know where they're going to come from. So what I put together tonight for this group was I built these calculators for you guys. So as a lender, what I run into the most is people not really understanding their numbers, their real construction costs, holding costs. Like guys, you'll pay utilities. And I swear MUD will bill you $100 a month for a vacant property because they can. And you'll have a winter, you'll be like, oh, well, the water, I didn't use it. Oh, well, $80 a month. And so all these utility cost things people don't really consider, I wanted to make sure I made room for those. So at the end, if you stay at the end, I have a QR code, just like Josh. Great idea, Josh. And if you fill out the form, I'm going to send you both of these. The flipping calculator is 2 pages where it'll give you a detailed itemized budget that I think is great for people to make sure they're not overthinking things or not missing out on important details. And then the DSCR loan calculator has a second tab full of lending, like advice, loan advice, tips. What do calculations mean? What's a cap rate? All that type of information. Because I think the greatest thing that's like plagues investors is an action. You're here because you guys take action. A lot of times it's the education piece. And that education, as I showed you in the first couple slides, can be so painful to learn. So anytime I can accelerate that, I think that's a huge thing I want to do for you guys. And it helps me help you because if you guys make good purchases, I can sell you 10 loans. If you make one bad one, we just get the one run together, And so selfishly, I want you guys to succeed because it helps me succeed.
If you're doing the accelerated appreciation, can you still do the cost segregation studies on that?
Technically, so here's interesting, and this is, first, who in the room's heard of cost segregation analysis? Okay, enough for this to be worth it. Okay, guys, so tune in. So I had to learn this the hard way, and even after my CPA said it to me, I didn't get it until I'd already bought all the studies. So in multifamily, where the concept of cost, so a cost segregation analysis is when someone intends to accelerate the depreciation, they bring out an expert. And that expert's job is to go through and tally every window, every furnace, every air, and all of these things have individual depreciation schedules, just like a roof or a car or anything else, right? And so you can use a cost segregation analysis to derive a larger depreciation number when you're doing accelerated depreciation. You don't have to. I did not know that. You can. You don't have to in multi or single. In multifamily, the deal is big enough where the cost of the study can move the needle enough in your depreciation that it justifies the cost. In single family, the numbers just aren't there. So like if I'm trying to get, my one-time depreciation and I'm going to write off $60,000 against this house, and I go and do a cost segregation and I go from 60 to 66, my extra $6,000 of like tax sheltering of income I'm able to shelter, that study cost $2 or $3 grand. So I just spent $2 or $3 grand to reduce my income by 6, which saves me like 3. So it's like the numbers don't necessarily work. Does that make sense? And so you don't have to do a cost segregation analysis. I stopped doing them on my single families. I just save the time, the energy, the headache, and we just take whatever the CPA says and run with it without the study. What's that?
How do they come up with the numbers?
The CPA does. Just based on, I think he literally just, accelerates the depreciation, Josh. Just not about a CPA, right? But correct.
You're breaking out all the finishes, and you're depreciating all the finishes, basically all the stuff that goes in it, all the accessories.
So either way you break out the land, whether you have a cost segregation or not, instead of doing individual finishes, I believe he just uses my basis, which would be like what we purchased the property for as your basis, and then our depreciation is based off that. So I think we derive to like a very similar number, and then we just save the calls and the reports and the cost. And I think on some properties I probably lose a couple grand behind, and on some properties I come out a couple grand ahead because of that acceleration depreciation. That cost segregation doesn't yield a high enough number compared to just what the CPA's base calculation is. I paid for the study for no reason. So yes.
The same for commercial property as well?
Commercial, because your price point is so much larger, the value proposition is there.
Okay.
Like it's a good investment.
Okay.
If you're buying $1 million, $2 million, $10 million, the cost segregation is going to save you enough money. And if you don't do it, everyone's going to look at you like you're stupid. In single family, you don't need them. And like talk to your CPA, it's probably not going to save you enough to justify. And that's kind of what we came to. Yeah, absolutely, absolutely. Anyone else? Cost segregation analysis? No? Go. So these will be here for you guys at the end. How I design them is the blue numbers are what you input, essentially, and then everything else you don't touch, and the calculator will just calculate everything you guys need to know. Yeah. So we've talked a lot, and we really haven't really told you how to buy a house yet. So I'm going to get into that now. As an investor, there's kind of 3 core ways, and I've used all of them. I continue to use all of them, and I think that's really important to point out because people are like, oh, well, hard money sucks. It's bad. Well, when you need it, right? And so it depends. Like, was hard money good or bad? Did you make money or did you not, right? And a lot of times if you made money on the deal and you had no other option, hard money was a good thing for you. And so the 3 types, are you guys familiar with hard money? Yeah. Are you guys familiar with that? So your typical like 18%, no questions asked. They'll come with you. They'll come for your knees if you don't make the payments. That's where you get the hard money side. The important things people need to know is that typically it's a 3 to 6 month loan. What I see happen a lot is there are extension fees. So it's like, oh, it's 18% as long as you can flip it in 90 days. If not, it's a point. And then another 90 days, it's a point. Well, I don't know about you. Like we have a pretty good system. Our average flip lasts 6 weeks. So like we're a machine. We have 2 crews full time, same colors, same system, same everything to try to consolidate the process. Our best case is typically 6 weeks, right? So if you buy it, flip it back on the market, 6 weeks later, you're rarely closing in sub 3 months. So you're almost always picking up that extra point if it's a 3-month note. So like things like that, I think people should think about. Option 2 is actually something that I rolled out this year that I'm really excited about. I like to call myself media money. So I'm not 18%, but I'm institutionally backed. So where hard money lenders are lending their own capital, I'm lending pension fund capital, essentially, that now is attracted to the investor space. And so our setup is different. I don't do 100% financing. I do 90% loan to cost. So what that is, if you buy it for 100 and it needs 50,000, your cost is 150. So in that scenario, I'd lend, 135, and the consumer would bring 15,000. Does that make sense? Yes, sir. So you bring a little bit of a down payment, but because you brought a down payment, you drop from an 18% rate range. Oh, did I say 100%? I thought there was 18%. You drop down to the 10 to 12% range. In addition to that, we lend all the construction. We lend 100% of the construction financing, and our notes are for 12 months, up to 24 months. So it's a longer note. We fund the construction, and our rate is significantly reduced. Takes us about 3 weeks to close them with no appraisal. So it's 10% down, 700 credit score, and you're in the money. For what part? 3 weeks. I mean, a lot of times it's like, how quickly can they get me the paperwork? But yeah, 3 weeks I like to tell people. I probably can get them done quicker, but I like 3 weeks. I can close comfortably.
Do you make people bring their own money to that, or can they, if they don't have it, can they borrow the 10%?
This lender does not verify assets.
Okay.
And Grant, in the back,
Yep.
does gap funding. So Grant, will you raise your hand? If someone was looking to be lent the 10%, which would be, I'm going to explain, I do something similar, and you'll see the power of being lent the 10% opposed to the going this route. Grant, I think, will get really popular here tonight. So that's kind of my goal for Grant. So we also had no appraisal. We do charge 2 points. Sometimes hard money has points, sometimes it doesn't. So like we do have more cost. When I stretched it out over a graph, about 3 or 4 months. If you can actually get in and out in sub 90 days, hard money was cheaper. If you can't, this will be less expensive. It's like as an investor, it's important to think about how long you're going to hold the deal. And then I think any investor's goal should kind of be to move their way left to right. Because the more experience you get, the more opportunities open up. And like how we're financed now is we have a commercial bank relationship. Who here has a commercial bank relationship? It's a good start. It's a good start. So I'm going to give you guys some tips on commercial banks. The 2 most important things that I think people don't understand is there are two sizes of banks. There's sub $1 billion in assets under management and above $1 billion in assets under management. I know when people start saying billions, like it's hard, like people start to like, your eyes start to glaze over, right? But what matters is they have different lending guidelines. It's like when I look for a banking partner in the commercial space, I always stay sub billion because I want somewhere that can be more flexible, that has less traditional underwriting, where my relationship and the volume I bring can have a greater impact than it can. And so that's like if you're literally trying to get the best setup with your bank, that's one piece of it. The second piece people don't think about is I really have a lot of success with ag banks. And Nebraska has a lot of agriculture banks. The reason for this is all of ag is subsidized. And the rates on it are typically low. And banks don't really make much money. It's like in a stock portfolio, you have like your alpha and your beta, right? You have the Facebook, the FANG, what's that? Facebook, NVIDIA, Apple, Google, whatever. And that's what you're hoping to get your return on. And then you're offsetting that return with your beta. That's like your Coca-Cola, right? It's going to return. It's not going to be incredible. Banks work the same way as an investment portfolio works. So for a bank who is very heavy in ag, they have too much Coca-Cola and they don't have enough Amazon. Seriously, right? It makes sense? And so us investors, we are Amazon, we are Facebook. They charge us more than when they charge the farms. We turn deals over more quickly. They get processing fees, they get points, they get their money moving, which is always good for a bank. Plus, if you're a flipper who makes money, they might get some deposits, which goes a long way. That's a third trick. There was a time, I needed a banker to get something done, and I was working with the president, and he didn't take my call for 2 days. And I showed up with $250,000 and asked to open a bank account, and he cleared his afternoon and helped me with my problem. So there is something to be said for assets under management, and banks take it very seriously. And so part of having that relationship is because if you can put capital in that bank, they can then lend that capital and make more money. So the more cash the bank has, the more the bank likes you, right? And so that's right, 10 times, baby. Yeah, exactly. And so it does matter. And so when I'm garnering a commercial bank relationship, I don't go wide, I go deep in that relationship. I keep my accounts there. I run all the loans through there. And because of that concentration, it has allowed me to go to closing and get a check for $75,000 to me, not from me. Does that make sense? When I had to flip that house, I said, hey, things are kind of tight right now. He goes, Neil, no problem. You don't have to make any payments. It's like, what? He's like, yeah. Oh, and you need another $150,000 to fix it up? I sure do. And he was able just to do it, right? If I were at a non-ag bank over $1 billion, no matter how concentrated that relationship was, I wouldn't have had that type of ability to get those like exceptions made for me, right? And so truthfully, those small banks are going to be very, very important. Are you guys familiar with construction financing, like your standard, like 25% down, 12-month note? Are you guys familiar? Okay, so if you're not, it took me 3 years, even with all this charm, before a commercial bank would lend me any money. For the first 2 years of my career, they just laughed me out, wouldn't take me seriously, and I had to lend off 18%. So I built my business on 18% interest until I had the reps, because when a commercial bank is lending, they're lending their own capital. They don't like, if you don't have a day job and you're only a flipper, they want to see that you've successfully flipped quite a few houses, right? They want to see stable income, they want to see credit, they want to see assets. And until you get here and have a track record of successfully flipping houses, typically they may lend you long-term debt, but they don't want to play in the sandbox of construction with you because it's a much greater risk. And so until you get to like kind of the third stage, these two are where most people, unless you have enough cash to go buy the house, then there's probably not a whole lot I can teach you. But this is where most people go until they kind of level up. So now I want to talk about how Beard Bros does it, because I kind of throw out some ridiculous numbers. I'm like, we bought 22 houses. And it's like, well, where did that capital come from? And ironically, it's not my money. So I have, I think, 70 grand in the company, and that's it. And right now we have 10, I think 9, we sold one last week, 9 properties, about 2.4 million on the books on our construction conveyor belt. So like for us, we try to continuously have a conveyor belt going of properties we're buying, properties under construction, properties we're closing. Right now there's 9 on that conveyor belt. We have another one we're closing in April, we'll be back to 10. And so we just keep this conveyor belt going, and we do that at that scale without needing our own capital. And how I did that is last year, me and my partner went out and we just started raising money. So we made 9 phone calls and we raised about $600,000 in 9 phone calls. I'm going to give you guys, this is worth showing up. I know you guys paid a lot of money to be here and hear me speak, but what I'm going to share with you, this is worth it. If you're ever going to raise capital, here's the pitch. Hey Josh, hope you're doing well. I hope you've seen Beard Bros. Yeah, we've been doing great. Hey, we're starting to bring on investors and raise capital. We're really excited to scale. You seem like someone who might know, I think you may have some friends that might be interested in what we're doing. Do you know anyone that might be interested in investing in us? And so however I pitch it, I don't ask Josh for the money. I ask Josh if he knows someone that might want to invest. And it totally removes the selling pressure of like calling your neighbor and asking for $100,000. It's hard to do, it's weird. But if you ask your neighbor if he knows someone who might want to like invest and beat market returns, then it totally removes the selling pressure. And we had a lot of success. No one's ever given me their uncle. I've been like, oh yeah, my Uncle Jimmy will invest. But every time I've used that line, if that person is interested, they raise their hand without me ever having to have the direct confrontation and friction of the ask. So what we did is we raised $600,000, 6 investors, at a 10% guaranteed return. So we pay out a 10% return every single month like clockwork. Scared the hell out of me the first time I did it, right? Best thing I've ever done. Things to consider, the money can eat against itself. So like if you have $600,000 in the account and you got to pay out your 10% interest, which is $6,000 a month, guess what? Now you have $594 in the account, right? And so I pay annualized 10%, I pay it out monthly. So annual return of 10%. So for every $100,000, it's $833 a month is what goes out. But what that allowed us to do was at the same time with that $600,000, we'll have $2.4 million of purchases locked in. And so the bank has now lent us at 7.5%, 75% of the money at a 7.5% rate, and then the other $600,000 is at a 10% rate. And so what that does for us is it gives us a blended interest rate. So I'm 100% financed like if you were hard money, but I'm doing it at a blended rate of 8.25%, opposed to if I had to bring my own capital, I'd be at 7. And I can flip a lot more houses with other people's money than I can my own. And so that really, like understanding this concept really changed the game for us once we got that piece down. And so the other piece of that is one of my favorite sayings, never say it to your banker, or they'll stop calling you back. If you owe the bank $1 million, it's your problem. If you owe the bank $10 million, it's their problem, right? And so, serious. And so when you can concentrate in one banking relationship that's sub $1 billion, that is ag bank, that will give you the flexibility, that relationship's worth its weight in gold. I'm going to give you 2 examples for that. I went through a lot of life events 2 years ago. I had a lot of debt, and I moved some to a 0-interest credit card. I forgot to set up automatic payments. I'm a lender that just got a 30-day late. I had a late pay in a decade. My credit drops from 760 to 680, and then all of my credit cards drop their max limits, and now all of a sudden I'm 100%, and my credit went to 580. My $500,000 credit line is up for renewal in 3 weeks, and my lender is going to pull my credit and see that I have a 580 credit score, and then I'm asking them to renew a $500,000 of debt, and if they don't, they're going to foreclose on me. Terrifying situation to be in. Called my commercial bank, heart's pounding out of my chest. He says, Neil, your relationship with us is beyond your credit score. We're not worried about it. We'll continue to lend. They didn't just renew the credit line, they didn't cut off any funding at all. And we continue to go. Yes?
Have you ever pitted one bank against another to get a better rate?
No, it's not worth it. Because I could really piss off that banker, especially in the construction world, and save a quarter point, which is going to save me $60 a month on a house that I had for 3-4 months. And so for me, it's a great, maybe it's because I am a lender. And when people do that to me, I was like, just don't call me back. Right? But essentially, what happens is you can, but here's a great story. There's a friend of mine, he has bought a lot of real estate portfolio, about $24 million, and he was constantly buying big buildings, raising capital, putting bank A against bank B. Oh, bank C comes in and made them all whittle down, right? When the pandemic hit, his bank stopped lending to him because his relationships were shallow. And he looked over at me, who had just stayed with the one bank that had taken really good care of me, and his credit was better, his finances were better. Oh, shit, I was going through a divorce, and I'm the guy my bank's lending to, and they're not lending to him because his relationship was shallow. So me personally, especially on the construction side, I'm never, I don't even think I get the best deal at my bank because I've asked a lot of favors lately. When I'm done asking favors, I'll start asking for better rates. It's kind of a trade-off. But I don't personally. Is that fair?
Thank you.
Absolutely. So the other thing you can do when you concentrate is we don't pay monthly interest to the bank, which is really, really impactful at our scale. Because if we have $1.8 million at a 7% interest rate, that's over $100,000 a year of interest. 112, something along those lines, right? And so our monthly interest payment is typically between $10,000 or $15,000 across the conveyor belt. Because of the scale, we said, hey, you would like it if we don't go bankrupt, right? And they're like, yeah, that would be good. I go, I think it'd be good if I didn't go bankrupt too. So I have this idea. How about you just kick all of our loans to negative amortizing loans and we pay 0 monthly interest, which for a flipper is paradise because if you think about your cash flow of your business and what's coming in and what's going out, when you're an investor and you're flipping houses, you're riding a roller coaster, right? Because you're holding being a flipper is how long can you hold your breath? Can you hold it long enough to sell that property and get paid? Because until then, it's ramen noodles, right? Probably all been there. If you've done any sort of volume, you've been there, and if you haven't been there, you probably will. It's just the reality, right? It really is. And so to be able to go to your bank and be like, hey, that collar of $10,000 to $12,000 a month of monthly interest for us to keep our machine going, let's negotiate something different and be able to pull that off of ourselves was incredible. So now my loan will go from 150 to 150, 700 to 150, 1,004. I don't care, right? It's just slowly ticking up.
So they
We're
just
gonna
grab it at the end?
They just grab it at the end.
Okay.
And so when we flip the house, our loan is bigger than when we started.
Right, right.
But we expected that.
Right.
And they get really excited about it because then their return goes up. Because if I just pay simple interest, which you're making monthly payments on, they're getting the same amount. Now that we are negative amortizing, they're technically making a little sliver more. And to them, it's a really exciting thing if they have the depth and the trust and the relationship that you're good for it. Does that make sense? Yeah. And so that is powerful because if I'm not spending 10 to 15,000 on just interest, how much more marketing can I do? How many more flips can I do, right? Because it's a whole, it all matters, right? It all comes together in the orchestra. So that's really allowed us to scale and push out more marketing, buy more houses, which overall velocity of cash. Any questions about raising capital?
They get their capital back at the end of the year if they want to pull out. How does that work?
Yes. So what we're doing right now is we take on 12-month notes, and then they have to give us a 90-day notice, and then if not, it just renews for 90 days. It's like if someone doesn't give me a notice, that doesn't give me the right to lock up their money for another 12 months, but you have to give me a 90-day notice. So even if you don't, well, then I'm going to hold your money for 90 more days so that I have that notice at the end. Does that make sense? And most of the money we've raised has not required DOTs, so a deed of trust. Some of the money has. It's like I raised some money for my attorney, and he would only do it if he could collateralize property. So we have some of our properties collateralized up in being able to raise the capital, but that's just fine. You know what I mean? This is a big one that's really powerful. I started here, first deal raising capital. At the level now we're raising capital. Any other questions about like the capital raise or structure before I move on? No? Just to make sure. Any questions? I've letting everyone come up for air before we hop into the takeout or long-term financing side of the investment cycle. Anything? Hal?
I'm waiting for the long term.
All right.
That's where I need to be.
Hal's a long-term guy. So what I spend a lot of time working on is what they call a DSCR loan. Who here has heard of a DSCR loan? You bet. I do somewhere between 10 and 20 a month for my clients. So I do mortgages, but my issue is I spend so much time on DSCR loans, it's hard to kind of make time for anything else. So how my team is set up is I run the DSCR loans, and my team handles my mortgage business. But it's a very powerful tool, and I think when I start talking about them, people assume they're for new investors, because when you hear the qualifications, it sounds like a high interest rate product. I think the rates on them, at least with me, are pretty good. I think they're incredible. And most of my clients that do these are my seasoned investors. Like Darren. Darren, which you guys will learn if he doesn't talk about health next month, is a very seasoned investor. And he has found these to be a good solution for long-term debt. And a lot of the bigger investors in town do as well. So,
how long can you do them now?
like length of note, 40 years. I can do a 10-year interest only that converts into a 30-year AM. You don't want that, but sometimes it's better than the alternative. Like I think, for example, why would you do a 40-year note? How a DSCR loan works is we look at what's your monthly PITI, principal, interest, taxes, insurance. Is your rent that you're getting on the property more or less than that number? And so if it's more than that, it's good. If it's less than that, it's bad. So if you're in a situation to where you're way over on your flip, which happens, you didn't hit budget, you can't change what it's going to rent for, the numbers are the numbers, that's where people will employ like a 40-year note to be able to have that 10 years of interest only to drop down that initial payment. The other thing we do in that scenario, and I believe I'm the only one in town that has it, is an 85% loan to value refinance.
What's your phone number?
Oh, we'll get there. I got you.
Whoa,
Yeah.
I've never heard of it.
Oh, we're just getting started. So I found out about these because essentially what happened was I was an investor. I watched interest rates go from 3% to 7%, and I watched my paycheck follow, do the inverse as a lender trying to sell houses and sell loans. And I said, what am I going to do? And I decided, I think it was 2021, 2022, I just started flying around the country, meeting with like private lenders, institutional banks, like life insurance companies. All of these players lend in the commercial space, and they're creeping more and more into the single family space. And so I really wanted to position myself to be on the front end of that wave, and it's kind of taken off. So when you're looking at a DSCR loan, the most powerful way that my clients use those is they'll buy the property. We're going to use really easy numbers for $100,000. That property needs $50,000 of work. So then they're into the project for $150,000, right? 100 plus 50. If that property can value at $200,000, they can take out a loan from me. Let's say 75% of that number, or that 200,000, is 150, and then they pay off the hard money and replace it with the long-term debt. Does that make sense? Yes. So that is like your standard BRRRR strategy. And what we have found is the DSCR loans, I think, are one of the most efficient ways to pull that off for a lot of reasons. Reason one is I don't need any income statements. W-2s, pay stubs, I don't need to know how much money is in your bank account. It reduces the qualification standard significantly. And even if you're crushing it, I never want to pay taxes. It doesn't matter how much money I make, it's going to look bad on paper. That's my goal, right? And so if you're a business owner, regardless of success level, it is difficult. Darren, have you ever tried to get a mortgage? How was it?
Yeah, it takes a while.
How many properties do you have? Can I ask?
120.
120. Yeah. So they need 120 insurance policies, 120 leases. They need 120, all the things that are going to go into that they need to know, right? And so you're able to skip out on that. We just look at that rent income and we close directly into the entity. A mortgage on a 30-year note can only be given to a person, not an entity. So that's kind of powerful because you're able to actually close within the LLC that you built. And the big advantage that I feel like I have in our market is I have no seasoning requirements. So what that means is you can buy that flip and flip it in 30 days, and then we can refinance the property immediately at that $200,000 value. And so I have flippers that do very, very quick turns, and we're able to help them keep up. And this is what I talk about when I talk about like velocity of money. If they went to go get a mortgage, they're probably 6 months, they're 6 months or a year, depending on the loan they're taking out, that they have to have that property before they can use that new value. Honestly, most DSCR institutions are the same way. And so if you think about it, if I'm waiting to get that cash back before I can buy the next property, you only can recycle that cash twice a year. If it has a 6-month seasoning and everything works out perfectly. So if I need that cash to buy a rental, it's limiting me to only being able to purchase 2 rentals a year. I don't know if you guys see Darren, but he is not old enough to have only purchased 2 units a year, right? You have to get the velocity and to be able to speed that up. So with the DSCR loan, no seasoning requirement, and being able to shave that down to you bought it, you flipped it in a month, and then a month later refinance out of there, theoretically you could flip 6 houses a year. That's a 300% increase in the growth of your portfolio. And so when people are like, well, is the rate 5.9 or 6.12? It's like, well, do you want to wait 6 months? Or do you want to buy 2 more houses before that? And honestly, the DSCR loans now, the way that we do them, are really sharp. I mean, I closed a DSCR loan at a 5.99% interest rate. Wow. This is an investment property with no income, no asset verification in an LLC. I mean, that's incredible. I mean, that beats what an investment mortgage would be right now. And so there are really, really solid options. The reason, and I'll get technical with you guys because I have already, the reason we're so competitive in the DSCR space is I founded Aspire Mortgage. There's a little sign on the door back there. There's headquarters for me. That's the upgrade. Before it was a white, 8x11 paper taped to my office in my room because you have to have a sign on your door to be able to pull credit. just so you know. If you want to be able to pull credit, you got to prove you have a sign on a door. And so you can tape it. You can tape a piece of paper and it's okay. So that's sign 2, sign 1's downstairs. But what made us so competitive in the DSCR space is with your traditional mortgage mindset, you have like your A paper, which is like your quality loans, and then you have what they call non-QM, which is scratch and dent, which is like all the hard stuff that's complicated, that doesn't look great. It falls into a different category. I've been involved in ownership in a couple different non-depository banks, like standard like lenders in town, and so I got to be a part of pricing our rates and understanding where the base rate is compared to the rate we sell. That's where banks make their difference. I know I'm getting way down in the weeds, but how it works in the traditional banking model is that scratch and dent business is where the DSCR loan falls. And so the mothership, let's say it's a large national company, their margin is bigger in their scratch and dent, and then you get down to the branch level. And then the branch level, their margin is bigger in scratch and dent. And sometimes the LO is like, well, scratch and dent is hard. And so the LO for the margins LO can be greater in scratch and dent. And so all of a sudden, DSCR loans were very expensive because every way down the path, your traditional institution is just kind of banging it and making more money on it. Does that make sense? It's just not getting the same quality. I looked at it and went, wait a minute, I get to work with people I enjoy. You're asking me to collect 10 documents opposed to 100 that it takes to get a mortgage, and I get to work with you over and over and over if I do a good job at a great price. So I'm very confident I am the least expensive DSCR loan option in Omaha. I'm neck and neck with every national lender I've ever been put up against. And it's because instead of looking at it as a scratch and dent side of my business, I said, you guys are my people. I'm going to charge you the same or less than I charge my mortgage clients. And that allows us to be very sharp, low 6s, high 5s in this space. So technically, you just need a 620 credit score. Please don't come with me for a 620 credit score and ask for a DSCR loan. It can be done, but typically what we run into is I can do it, but your LTV is capped at 50%. So it's like, yeah, it exists, but the deal doesn't exist. So it's like a really long-winded way for me to tell you no. Yes, sir.
Hey, does the DSCR loans that you guys offer, does it gotta be in Nebraska or can it be anywhere in the United States?
I think I'm like 36 states. So yeah, I'm closing one right now in Tennessee, Missouri, and a couple in Nebraska. So there's a couple of no-no states, like typically the coasts have higher regulation, and I just saw you stay out of those. But I'll have a whole map. So essentially, you call me, you go, can you lend here? And I pull up the map, and if it's blue, I say yes. So just so we know it's all good to go. But yeah, great question. Any other questions, like on the DSCR loans or what we can do there? So ideally, you want to be about a 660 credit score. I can go up to 9 units. The really sharp pricing is anything from 4 units down. If you look at conventional, once again, like your conventional loans end about 860. I can do a DSCR loan up to about $3 million. I'm priced on a $2 million one right now, and they're loving it compared to what the other options are available in the jumbo investment space, because they're not great when you're looking at 30-year debt. So you can be very sharp, especially in larger loan limits. Being able to close directly in the LLC is big. And where, like I said, the things that stick out to me the most are 0 waiting period to allow you to speed up the velocity of those turns, allow you to grow that portfolio quicker. Yes?
Go back to the last slide. Why are you specific about the use? I guess I see property type, but I'm seeing use there, right?
Property type?
Yeah. Those are short-term rental, right?
Yes, I apologize. Thank you. Yes. So you can use a DSCR loan on single family or multifamily. I technically, it says 2 to 4. I can do 5 to 9. The rates are just not good. So typically I'll just say, hey, go to your commercial bank. But 2 to 4 is solid. We can do short-term rentals and condos. So Airbnbs, furnished rentals, we can do those too. We can do the DSCR loan before you put the tenant in place. So you can buy it with a DSCR loan and we go off what the appraised value is. Or for my flippers that move really quickly, we can refinance them out before that units even rented based on what the appraiser says the rent value is. And so it's just another way to reduce documentation and just kind of increase speed. Great question. So how do you do it? There is a software called AirDNA. Yep. Have you guys heard, who's heard of AirDNA? Who wants to own Airbnbs? Perfect. Then you should know what you want to check AirDNA. Yeah. Yeah. And how are you guys Airbnbs doing?
We're actually just launching ours.
Okay. Oh, really? Okay.
So I think we'll be fine.
Think it'll be okay? Yeah, fair enough. What about yours?
Mexico and then Florida.
We got some, this is kind of all around the country. This is great. Very good. Well, they're probably doing better than here. If you want my advice, it might be jaded and biased, but I don't really think we're in an Airbnb market anymore. I think there's three, I'm sorry, another tangent, I hope you guys don't mind. I think it's important though, because I think there's always like willful like optimism, like I want to have Airbnbs that used to be good, therefore they must still be good. And I think markets change. I think there's a lot of factors specific to Omaha that changed it forever. When the pandemic came through, everyone got more comfortable on Zoom. You don't fly out your head CEO, your CFO, your whatever to go on an appointment anymore. You just hop on a Zoom call. That became naturalized in the business. You're not flying here all the time like you were for business. The other thing that changed is we used to have an enormous amount of nurse staffing and nurse recruiters. That's dead. And why it died is because the recruiting companies, I kind of like my seat as a lender because I get to see what everyone makes. I get to see everyone lives their lives. And sometimes you can like look at a financial profile and then they start talking. You go, yeah, it makes sense. Like you see it, right? You can see how their life plays out on paper and in reality, right? And so I got to watch incomes and it was extraordinary. Pre-pandemic versus pandemic, a nurse recruiter used to make $100,000 a year. During the pandemic, they were making $300,000 a year. And why that was is because the hospitals had such a demand for nurses to keep up with COVID that they needed all of this extra staff. And so the nursing recruiting companies could really egregiously charge for their service, which capitalism, we know when there's a market and a need, you fill it. But now what's happened is A, that demand is not the same as it was during COVID. And B, hospitals will never allow nurse recruiting companies to bend them over the barrel like what happened in COVID. So hospitals will just stay a little bit overstaffed. They'll just carry 5% extra staff, and then they don't have to worry about how they're going to get extorted by a staffing company. And you can see that play out in real time because there's been a huge closure of staffing companies, a huge reduction in profit, and a lot of them have gone out of business.
You probably saw the differences of the income on the ones that were recruited and flown around the country versus the ones that live here at the hospitals.
Mm-hmm.
They got paid less.
Mm-hmm. So are you saying that the traveling people got paid more? Yeah, they sure did. They sure did. And there's a piece of that too. So they just reworked how that system worked. But for Omaha, Nebraska with UNNC, that was a huge draw to the Airbnb market. It's not a draw anymore. And so I had 6 Airbnbs. I think I'm down to 3, and they do okay. I have a management company. After all the expenses, I net, after it's all said and done, what I would have netted if it was a long-term rental. I make a little bit more, and then I pay a management company, and it's the same. But since I've already paid for the furniture and they're furnished, I just leave them. Important to know, if you like to take out loans and refinance, don't have Airbnbs. It makes it really hard to get the refinance debt you want. Your LTVs are reduced, your rates are higher, banks don't like the income. It is harder all around, whether you're going commercial bank or you're going DSCR loan or mortgage if it is an Airbnb. So if you have a niche in a Daytona or a New Mexico and Florida where there's a huge draw and the revenue increase justifies the reduction in the velocity that is created by an Airbnb, or if the revenue is so extreme, it may not, because you guys may have markets that are more appealing to it. But if you're in Omaha, Nebraska, and you see this idea of burring, don't throw Airbnbs into the mix. would be my advice, because it's going to be a lot hard to get that takeout debt, that secondary loan, once you have that Airbnb going.
Well, you've probably seen what's going across the market right now with those guys doing arbitrage instead of purchasing.
Yeah, which is interesting, because I think I have the opposite. Are you guys familiar with that? It's like you rent the property and then you turn it into an Airbnb, so you make the cash flow difference. I think you're putting all your energy into the wrong direction of real estate. You see what I'm saying? Like, I
earning towards owning the property is, the appeal of doing the short-term rental is you're buying the asset ultimately.
Mhm.
When you're doing that, you're putting all this work into buying somebody else's asset still.
Exactly. And I have a different PowerPoint. That's not this one that I've done, where I break down. I have 3 PowerPoints on finance. I just realized that. And this other PowerPoint where I break down like your return, right? And it's like your cash on cash return is 8% and it's dwindling all the time. There will forever be margin compression. Deals will always get slimmer over time. That's just kind of like the reality. In California, they buy on negative cash flow. Here we don't. Sometimes it feels like it, but we're getting there. And so when you put it on paper, the rental returns at 8% cash on cash. So how much cash am I getting out of it for my investment? But then when you put together principal reduction and the tax write-off and the appreciation of the property, if you look at the total impact that has on your net worth based on the cash that you put in, typically I come to a number of like a 20 to 22% range based on the money invested. It's like, in my mind, to your point, the cash flow is great. It is 8% of that 22%. And the 14% you get whether it cash flows or not, ideally. And so when you are arbitraging an Airbnb, you're giving up the majority of the return of owning real estate.
So I have one more question.
Yes.
So can the DSCR loans that you offer apply to other asset types?
Yes, so I can. So I can do like mixed use. I can't do true commercial, I can do mixed use. What you're gonna run into is the rates aren't as sharp. So it's like you come to me for the 1 to 4 and the rates are in the 6s, everything's great. You come to me for 5 to 9 or a mixed use building and my rate's like 8 or 9. And so at that point, you're better off going to the commercial bank because they're just better suited, unless you really want the 30-year. But if they'll give you a 25-year AM at a standard bank rate, which are 7.5%, you don't want my 30-year debt at an 8.5 or 9. Like, you're not really going to be saving much money. You're going to be paying more interest and having less equity. So I can, if someone's like, but like, for example, maybe they can't get bank approved, then the solution makes sense and it's a yes. But typically I like to help people where I shine because then they come back. Does that make sense? And that's just an area where I think commercial banks are better served, or serve the client better.
Right. But it could be like case-by-case basis.
100%. Yeah, if it's like, well, the bank's 9, or like, because of how we did our taxes, we can't show enough income to get approved. That's where the DSCR loan comes into place. Absolutely, absolutely. And I think I've said enough about DSCR loans. I know I probably have. In case you needed more myths, made a page of those, but I think we covered them all. So as this nears to a close, I just kind of want to zip to the end here because I think I've used my time. But if you guys scan this QR code, it's going to ask you for basic information: phone number, email, name, and then all those 2 calculators that I built for you guys are all available.
Make it bigger for you guys? Is everybody getting it?
Yes, what's your question?
I have a question. Where do you get the bulk of your deals?
She asked me, where do we get the bulk of our deals? Yep, of my flips. Yep. So the majority of our flips come from direct to sale marketing. So we have a mail campaign, send out 4,000 to 5,000 mailers per month, every month. And that has been our number 1 returning source. 0 on that. On mailers, on a flip, I spend about 4 hours per property that Beard Bros flips, which is a pretty good return on time because I don't have the company. But we just... Is it not working? No. No way. You guys know how hard I worked to get here for this moment? Everyone pull out their phone and know that I pulled it off. And you're telling me it's no good? Ah, no way.
Yeah, I don't think it's even on.
Hold on.
We need a loan for it.
Yeah. Can you guys give me like 2 minutes and I'll make sure that there's a QR code you can scan? Yeah, let's try that. So why Josh is so graciously making us a new QR code? Anyone have anything they want to chip in, say, ask?
Any questions?
Any questions?
What's the largest amount of property you built on in one day?
6. It was cool. It was at the golf course at the RIA golf outing, and the banker came to me. So I got to sit there in front of all the investors and sign all these docs and hold the folders. It was a little bit of a flex. It was cool.
Before you did mailers, like kind of building your business, did you always do mailers? Or
That's a great question. Hey guys. He just asked me about what worked at our marketing and what didn't when it came to finding off-market deals. Would you guys like to all hear that? Yeah. Cool. So I tried it all because I said there's no way mail works. Mail is for old people. Mail doesn't work. So we tried bandit signs. We tried websites. I tried driving for dollars. I door knocked. Literally did everything I could think of before I tried direct mail. Direct mail was consistently the single highest returning lead source that we have. So we buy 1.5 properties per month just from direct mail. And it's about $2,800 to $3,000 in marketing costs per property. So in my world, if our average flip nets $30,000, and we can keep our marketing cost to 10% of that, we're really happy. So that would be my advice.
Thanks, man.
Yes, what was your name?
Dave.
Dave? It was nice to meet you.
I appreciate you, boss.
Yeah, what was your name?
I need your phone.
Yeah.
I have a few houses that
Let's
you
chat.
might like.
Yeah, let's chat. I can
give you my business card.
Please do. I sat my phone down. Do you see? Oh, my phone's been recording me this whole time. Let me see.
The first number's mine. Second one's my old man's.
Duke's Remodeling, family owned.
That's my old ones I got.
Okay, what was the name?
Jorge.
Jorge?
Yes, sir.
Nice to meet
Nice
you,
to
man.
meet you.
Thank you. Dave, thank you for coming in. Oh, wow.
She's trying to get some water to take her back.
Oh, gee. He's asleep. You okay?
Yeah, he had a 20-minute back. Daniel learned a lot.
Did you? Cool.
Good stuff, man.
Yeah, what's your name?
Andrew. Yeah, I just joined the SubTo community.
Nice. Yeah. Yeah. What do you do now?
I actually laid off from work at the moment. I work for Concrete Industries in Lincoln. So now I'm trying to figure out how to get this all going. Yeah.
It works? It works. All right, guys. Just scan the QR code here.
It's a very small QR code.
But it works.
Does it work?
Tiny but mighty. Please. What's that?